Hi, this is Archna from Archna Trades. I'm going to be talking about Brokenwing butterflies. Yes, this is an option strategy. Nothing to do with butterflies. It's just the way the profit graph looks like. It looks like a butterfly. That's why the name is butterfly. So let's go ahead and look at it. So everything I say here, it's a disclaimer. I'm not a financial advisor. Trading is risky. Trade setups, any information I'm giving is only for educational purposes, not financial advice. This is just merely examples of what me and other traders do on a daily basis and have found success. Manage your own risk, and everybody should only trade the amount that they're comfortable losing. Now about me. I have been trading for more than 8 years now. I am currently a contributor at Laduk Trading. I run my advanced options Discord channel at Laduk Capital. I also do one-on-one options mentoring sessions and run my own Twitter Trade Alerts subscription. Recently, I've started 2 Substack newsletters that list my option trades and equity trade ideas. Check out Archna Trades for options mentoring. So now everybody thinks about options, right? Options basics. There are only 2 things. You have a call, you have a put. You can either buy a call, buy a put, sell a call, sell a put. These are the only 4 things that you can do with options, right? Buying a call is the buyer has the right to buy the stock at a specific price before the specific date, right? Before a specific date. When you buy a put, the buyer is having the right to sell the stock at a strike price before specific date. Now, when you sell a call, you are assuming the obligation to sell the stock at the strike price. When you sell a put, you have the obligation to buy the stock at the strike price. These are the only 4 things that you can do. Then why are there so many complex option strategies, right? Why do we do all that? Any strategy, however complex, is just a combination of this: long call, short call, long put, or short put. We can use different expirations, same expirations, have different combinations, have more short calls than long calls, more puts than calls, and so on and so forth, right? You can make as many combinations as you want. But what is the purpose? Why are we doing that? Why combine? Why make it complex? And what is the purpose, right? So when you are buying a call, what are you doing? You are assuming that the stock is going to go higher. You have to be right in the bullish direction for you to make money. So you can do the opposite, right? Sell a put. That way, you just don't want the stock to crash below, but it will still make you the money, right? But when you sell a put, it requires more capital. You have to put margin down. So what happened here? In an attempt to reduce the direction risk by just buying a call, now that you're selling a put, you increase the capital requirement. So if you want to try and eliminate or reduce direction risk or capital risk, we can combine different option strategies and we can accomplish that. You can reduce the direction risk, which means you don't have to be always right and still make money, right? And you don't have to outlay that much capital by selling a put, right? So you don't need to do that either. We can make these combinations and increase our chances of making a profit. By reducing the direction risk, we are increasing probability of profit, correct? I don't necessarily have to be right in my assumption, in my direction, which means the probability of me making profit has increased. When I reduce my capital outlay, that I have reduced the probability of loss. So having knowledge of these trade strategies and the Greeks, we can optimize for probability of profit and risk in the trade. So let's go ahead and think about what is a broken wing butterfly. Before we go to broken wing butterfly, we need to know what is a butterfly. A butterfly is a combination of a debit spread and a credit spread put together. It is generally a debit trade. A call butterfly is going to be one call, right? One long call, which means you've bought that call. Two out of the money short calls, which means you sold those calls. And another long, which is further than the short call, out of the money call. So it's, you are doing one call here, two short here, and one over here. Okay, so that's the call butterfly. Similarly, in put butterfly, you have one put, two short out of the money puts, and another long further out of the money put. So this is a regular butterfly. Okay, we'll go through what does that mean. So this is Tesla's chart from yesterday after close. And you saw, okay, it came to the lower end of the channel and it's bouncing. And so you think it is going to go probably to this 900 area, correct? Tesla closed at 824 yesterday, and you think that it can go to 900 before this Friday, and you want to enter a long trade, okay? So what is, I look at the option chain, and the expected move for this week is $45. So 825, I'm just making it rounding, right? 825 plus 45 is around 870. So 870 is where it can go to. So trying to buy a $900 call for $1.70 makes no sense to me. It's way out of the money, and the chances of it going there is less. So you can think about 870 is the expected move. You could try and do 860, 880 call debit spread for $4. This is for this Friday. So you are putting in $4 to make a max of $16. The risk reward is there. But again, you have to be right in direction, right? We are talking about trying to optimize the direction risk first, right? So a butterfly, my ideal setup for a butterfly is you need high IV, short duration, right? I'm trying to buy for this March 11th, short duration, check. High IV environment, which we are in, check, right? It is choppy, but it can easily pin to certain round numbers, check. So it is a good setup for a butterfly. So we could do the debit spread that we had, right? 860 to 880. You paid $4 for it, which means Tesla has to close on Friday about 864 for you to make any money. $4 that you paid plus the 860 strike that you do, add that, that is your break even for the call spread. So let's think about making it this call spread as a butterfly. We combine this debit spread by selling another call credit spread on top of it. So we can do an 860, 880, which is our $20 wide debit spread. And we can add an 880, 900, another $20 call credit spread. Now the trade goes from $4 debit to only $1.07 debit. That means I'm spending only, instead of spending $400 per contract, I am spending only $170 debit. Why? Because for 880, 900 call spread, I am getting $2.30 credit. Okay. So we still make money only if Tesla goes higher. So what was the difference by doing a call debit spread versus doing this butterfly, right? I'm having less debit, so I'm risking less money. If I've put less money in, I can lose less money. Instead of losing 400 per contract, I can lose only 170 per contract. So I reduce my risk. Another important thing is because I've put less money in, my break even is now not 864, it's 861.7. So I need Tesla to close above 861.70 to make money, not 864. So by having less debit outlay and making it this way, I was able to reduce my break-even cost and my risk, okay? So this is the risk profile or the payoff diagram for the butterfly, okay? Now, since the debit spread, right? The debit spread part is also $10 wide. The credit spread part is also $10 wide. There is no margin required or no buying power reduction other than the debit of 170 that was paid. Profit is going to be about 861.70. On expiration Friday, if Tesla expires at 880, okay, that's the ideal scenario, 8 pins at 880, then the $10 wide debit spread is fully in the money. And the $10 wide credit spread is fully out of the money. So if a credit spread is out of the money, it expires worthless. So the max profit is $20, which means times 100 for every option trade, you multiply by 100 because we control 100 shares. So your max profit is $2,000 per contract. Okay. So you would say, why do you need anything else, right? If butterfly is such a good trade that I can risk $170 to make $2,000, I would do it daily, right? This strategy is good, too good to be true sometimes because it has low probability of profit. You have to be not only right in direction, which we could have done on doing call debit spreads or only calls, right? Tesla calls are pretty expensive. To buy an 860 call yesterday when I was looking at it, it was more than $9. Okay, so in $9 you pay at 860, your $900 per contract versus a call debit spread, you would have paid $4. Okay, versus a butterfly, you would have paid $170. So you're talking about it's the level of risk you want to take in these three different scenarios. When you buy a $900 per call in Tesla, 860 call per contract, $900, that 900 above or $9 above 860, Tesla has to close above 869. So just buying a call, your break even is 869. You start making money after 869. All this is definitely we are talking about by on expiration, right? So 869 is your break even if you just take a call. If you take a call debit spread, your break even is 864. You still need Tesla to go higher, but now it doesn't have to go as high as 870. It has to go high as 864. By doing a butterfly, you've put less money, right? But you've brought in your break even also lower, which means it doesn't have to go all the way to 870 or even 864. It has to go only up to 862 for you to still make some money. So by this strategy, combining certain things together, we were able to reduce risk by putting in less money. We were able to reduce the direction risk also. You don't have to be correct till 870. You get my point? Now, let's think about it, that you have to be right in direction and in time. When you do a butterfly, you are saying by this Friday, it's not only going to be, I'm right in direction, I'm right in time. Okay. And because you have a credit spread and a debit spread together, the spread, right? The credit spread has to lose all the credit that it has given. So you have to wait closer to expiration for all this to materialize, which means if you do a 860, 880, 900 butterfly, Tesla going at 880 today doesn't help. It has to pin at 880 close to expiration on Friday for the entire credit spread, whatever credit you got to get evaporated. So you have to wait closer to expiration, be right. Something I was, okay, I don't know, something sold. You have to be right in direction and in time. So here comes the broken wing butterfly. Okay, one step further from butterfly. Okay, this is also, since it's a butterfly, you still need high IV. Okay, now we talked about butterflies, a combination of debit and a credit spread. In a regular butterfly, we did 10 wide, 10 wide. Okay, you can have 5 wide, 5 wide, 20 wide, 20 wide, 100 wide, 100 wide. So both the debit and the credit side, the width is the same. Whereas when we are trying to breaking it, we are having different width of the debit or the credit side. So if we can vary the width of the debit spread or the credit spread, we vary the risk reward and the underlying assumptions of the stock direction that we are making. Let's see how. In our Tesla example, what if we bought a $10 wide debit spread, but only sold a $5 wide credit spread? Or if we bought a $10 wide debit spread, but sold a $20 wide credit spread. So we are changing the width of the debit and credit spreads. Okay. And since the wings are different, right? If a debit spread is having only 10 and the credit is 5, so the wingspan of the butterfly is different. That's why we say it's a broken wing. Okay, the name says it. So let's see when doing these kinds of butterfly is helpful. We are still on our Tesla example. Okay, we are still doing the March 11th. Instead, and now we can do 860, 870, 890 broken wing butterfly. So it has a 860, 870 debit spread, but it has a 870, 890 credit spread together as a broken wing butterfly. This is called a credit. I'm getting a credit here. The credit spread is outside the move of the expected move. I was talking about that Tesla has a $45 expected move. So it was coming to 870, right? So I am selling a credit spread beyond the expected move. So hopefully it doesn't affect my margin. Okay. Now it's a $10 wide debit spread, $20 wide credit spread. I'm getting 51 cents credit. What do you mean by 51 cents credit? I am getting paid to do this trade. Now you would wonder how is the market paying you to do this trade? Okay, let's see. The $10 wide debit spread can be done for $2.23 debit, but the $20 wide credit spread, right, the 870, 890 can be done for $2.74 credit. It requires $2,000 margin or buying power reduction. Because you are doing a credit spread, you have to put the width of the credit spread as margin. So this is a $20 wide, so $2,000 margin per contract we are talking about. So 274 credit minus the 223 debit, we get 51 cents credit to do this trade. Okay, so how does this work? By doing this trade for a credit, we have eliminated the risk to the downside completely. Okay, now if Tesla goes up, I make money. If Tesla goes nowhere, I make money. If Tesla goes down, I make money because they paid me to do this trade. I can keep on expiration. If everything is out of the money, Tesla is at 850 around when I saw before, right? It was at around 850 or 852. If it expires here, I'm fine. I still got money to do this trade. So I have no risk to the downside at all. I got $51 credit. If Tesla goes up, I will be able to close the butterfly for even more credit. Okay. And hence it would be a profitable trade. If Tesla goes above 870.51, then it becomes a loser. Okay. We will go through this is the payoff graph. I will show. Okay. So the max profit is the width of the debit spread, right? So here you have the $10. This is the $10 wide debit spread. This is the $20 wide credit spread. The break even is 870, where our debit and credit starts, right? Plus the credit I received. So after 870.55, you can see it starts rolling off. This is how I start losing money. If it goes here, I got 51 cents credit. That is fine. I still keep the credit. So eliminated the entire downside risk. If it closes on Friday at 870, my debit spread is fully in the money. So I get $10 there. My credit spread expires worthless. So I made $10 when they paid me $51 already. Okay, they paid me to do this trade and I still made $10. So I have no risk to the downside. A stock can do only three things: go up, be sideways, or go down. So out of the three ways, I eliminated risk to one side. I have possibility of an infinite gain. And I don't need to be that correct, right? So what is the catch? Why don't we do all this all the time? Where is it losing? Because we have a $20 wide credit spread, if it blows through, say Tesla comes up with something and tomorrow it goes beyond 900. So now your debit spread is fully in the money. Your credit spread is fully in the money. So you have gotten only 51 cents, right? For the $20 thing. So you will have the entire debit spread, $1,000 profit, right? Your loss is going to be the credit spread, width of the credit spread, which is $2,000. Then the debit spread profit that you had, you have to take that off. And then the 51 cents credit or the $51 that you got, that you have to take off. Your max loss is $949. Okay, that much per contract you will lose if it blows through. Okay. So why should we do this kind of trades? I do these trades quite often because it eliminates risk on one side. So the probability of profit increases because out of the three things that a stock can do, go up, be sideways, or down, I have eliminated the downside. Okay, so 2 out of 3. My probability of profit from the regular butterfly has increased. Another reason to take this trade is we are taking advantage of the high IV environment we have. That is the reason I am able to get more credit, right? Another reason to do this kind of trade is that as price goes higher, the IV usually collapses or IV reduces. So we can be profitable faster as the movement is higher. Another thing is, even though pinning an exact price where the debit spread is at max profit and credit spread is worthless, has lower probability. But once in a while, things happen, right? You guessed right and it pins exactly. So if that happens, you have infinite gains. They paid you $51 and you still made $1,000, right? Why infinite percentage of gains? Because you have to always remember they paid you. So whatever, okay? Greed and gamma. You keep hearing about gamma a lot, right? Yes, we can lose $949 on this trade, but the scenario happens when it blows through your debit spread and gets past your credit spread too. But that means that we were profitable in the trade, right? Tesla today at 845, closes at 824 yesterday, does not go to 900 overnight. It has to go through your 860, 870, and 880, all the prices that you are covered with, right? And then blow through. So it means that you were profitable, but you waited and tried to get the max profit. So you're trying to be greedy, right? It just doesn't blow through unless and until, yeah, there's some overnight news, but unless that something like that happens, your stock is going through slowly towards your credits. The first goes through your debit spread, then goes through your credit spread, and then you reach to max loss, right? So you were profitable before and you chose not to take the profit. Since this is a short duration trade and you are selling a premium here and we are putting a margin for this trade, gamma plays a huge role as expiration is nearing. So as long as the stock, we are talking about the tent, right? You saw the triangle that we are drawing, the tent. So as long as the price is in between that tent, you are profitable and you can make money, because IV is contracting as price goes higher, as expiration is nearing. And so your gamma, because of the gamma and all the Greeks that we listen on FinTwit, if you are active on FinTwit, right, those Greeks play a role and you are profitable, but you are choosing to wait and trying to get that infinite gain. That's when the problem starts. Okay. Trying to wait till the last minutes before expiration can put your margin at risk. That's why I'm calling greed and gamma. Okay. My rule, let's recap what this kind of a broken wing butterfly for credit is. Okay. I try to get 4 to 5 times max of the debit or credit received. So here my order would be to sell the butterfly for $2.50. So I am never risking my margin at any time. Of course, if I am seeing it's a Friday and Tesla is not moving much, and I can, instead of 2.5, I can get 5, I can get 6, I will try and do that. Don't get me wrong, that I'm not going to try and maximize my profit there, but I'm never trying to put my margin at risk, because I don't want to be greedy here. They paid me $51, and if I can get $2.50 on over it, I made $300. It's fine. I didn't pay for it, right? So for me, that's how I trade. So broken wing butterflies can be configured to receive a credit. It eliminates risk on one side. Now, why am I, because this is a recap, I am not saying it eliminates risk to the downside here, because you can configure similar butterfly on the put side, correct? Where you are looking at the support instead of resistance and trying to pin there, correct? So you can do this kind of butterfly both on the debit side, on the put side or on the call side, okay? So this is one. Now let's think of another way. Here, before we had the debit width was smaller, the credit spread width was larger. Hence, we got a credit. Now let's think of a broken wing butterfly where it's still a debit. You are paying for it. Okay. Suppose you think that, putting margin down for a trade, I don't want to do that. I don't want to trade like that and keep always worrying about that $949 per contract that I have to shell out. Then we can configure a trade where we do 860, 880, 890 broken wing butterfly. where we have a $20 debit spread and a $10 credit spread, right? So since the debit spread part is bigger, we are paying for the trade. The credit spread is smaller, so we'll get smaller credit, so it won't cover for the entire debit. So we are always going to be paying for this trade. $20 wide debit spread, but a $10 wide credit spread can be done for $2.64 debit. Okay, so now let's recap what have we done. Buying an 860 call, just an 860 call, I could have done for $9. Buying an 860, 880 call debit spread, I could do it for $4. Okay. The regular butterfly, I could do it for $1.70, right? This was the regular butterfly. I have to wait till expiration day for this to work. Regular butterflies, you most likely have to wait till expiration date. Now we did a broken wing butterfly with credit where it was 860, 870, 890, where we got money, $51 credit. Okay, let's not talk about that because we are talking about debit here. So let's think about only the debit parts that we have been talking about. And here we are doing 860, 880, 890, and we are paying $2.64. Okay, risking less than the $4, risking less than the $9. Okay, so butterflies are cheaper. Broken wing butterflies are cheaper, which means you are putting less risk. But the moment you put less money in to the trade, the chance of you losing less is more, right? Since the width of the debit spread is greater than the width of the credit spread, there is no margin. The width of the debit covers the credit spread margin. This trade eliminates risk to the upside. Okay, now you paid $2.64 for it. So above 860 plus $2.64 is the break even. This trade makes money only if Tesla goes above 862.64. If it goes down, the debit is lost. If the stock blows through, right, overnight there's a news and Tesla is at 900, you're still profitable. If it pins at 880 at expiration, the debit spread is at max profit and the credit spread expires worthless. So the max profit is going to be $2,000, which is the width of the debit spread. Now, if it blows through 880 and even beyond 890, the debit spread is at max profit. The credit spread is max loss. The debit spread profit is $2,000. The max loss of credit spread is $1,000. You are still profitable by $1,000, which is simply put width of the debit spread, which is 20, minus width of the credit spread. So you can still make $10, okay? But you paid $2.64 for this. So the max profit is going to be $736. Okay, that's the max profit that can be done for this trade. So this is the payoff graph. It looks like, okay. So this is the money that you paid, right? $2.64. That 264 is the max loss that can be there. If it goes down, that's the max that you can lose. This is the $20 debit spread width, right? As long as it is in this triangle, anywhere in this triangle, you are going to make money. There is no risk to the upside because your debit spread width is bigger than the credit spread width. Okay, we talked about how 736 is the max profit that you can make. Reasons for doing this kind of a trade. As usual, we are able to eliminate risk to the one side, right? If it goes up, how much ever up, There's no risk to that side. So as usual, you are increasing the probability of profit. We are taking advantage of the high IV environment we are currently in. We don't require any margin, and it still has, you pay $2.64, it still has 1:3 risk reward. So that's another way of doing this. Now, as I told you that I'm not waiting usually till expiration to get rid of my butterflies. My rule is get 4 to 5 times. So in this, there is no 4 to 5 times because I paid $2.64 here. I am waiting till closer to expiration to try and get money. Okay. Since there is no risk to the upside, the trying to hold till the expiration is more feasible. But of course, if it starts going in the opposite direction and it starts going down, it becomes a loser. Okay. And then you can still try and look for the pin and get your max profit. So Brokenwing butterfly can be configured as a debit or a credit trade. Under both conditions, risk to one side is eliminated. It needs high IV. Why high IV? Because you are selling premium, right? There is a credit spread involved here. So because of that credit spread, you are always looking for high IV. There's no point selling premium in Disney, which has not moved for so much, right? You won't get money in it. You won't get credit. So you will still be paying more money. So the more high IV, the better for the butterflies. But then still, right, when there is high IV, what is the meaning of high IV? You are expecting more volatility, which means you're expecting more movement. If you're expecting more movement, then how is pin possible? So you need to be able to identify specific resistance or support zones where a pin is possible. Using high open interest strikes for pinning action is another way of looking at it and trying to configure a butterfly around it. That also can be done. I was looking at the Tesla trade, okay, before I joined in let me go to this one. This credit trade, right, which we got $51 credit for, was going for another credit of $1.05. So I had already gotten 3 times the money if I had closed that butterfly today. Okay, before I came to talk. This debit spread this Brokenwing butterfly where the debit spread is bigger than the credit spread, that was going for $5. So that had also doubled. Okay, so you don't have to wait. Sometimes filling a butterfly is difficult. So doing something like that in Tesla or very liquid names, it's easy to get filled. So I think I would have been able to get 3 times the money in the credit scenario of the Brokenwing butterfly and at least double the money in the debit format. And this was the trade that I put in the morning, and in half a days of work, without risking huge amounts of money, both the trades were profitable. If you want, I have put another butterfly trade in IWM where I'm thinking it would pin at around 200, 201 today. So I've configured a butterfly there for today's expiration. I bought it today in the morning and it's for today's expiration. I paid $1.05. I paid $1.20 and my max profit is $5. It's IWM butterfly. So if you have any questions about Brokenwing butterflies or butterflies in general, you can ask me. I'm done with my presentation. So the promotions that I am running right now. So if you want to learn more options and learn from me how I trade, you can check out Archna Trades for mentoring and Trade Alert subscription. These are the two Substacks that I write. So if you want, subscribe those Substacks are free for now. And you can use Women's 20 to get 20% off for any of the mentoring products that I have. Any questions? If you have any questions, let me know. Okay. Website is and this is the Substack that I write. Yeah, they are. So yeah, these trading strategies are complicated. But you saw, right? What I am trying to do with these is eliminate risk. Buying calls is like, yes, it's not that I don't buy calls, okay? Of course, there are times when you can buy calls, when volatility is low, there is no chop happening, right? The direction is clear, then I'm not doing butterflies. You have to realize before, now commissions are lower than before, correct? With Robinhood and all other things, even Thinkorswim, reduce the commissions. Tastyworks, which already had less commissions, but you're looking at butterflies. There is one call that you're buying, two calls that you're selling, one call that you're buying again, the wing. So there are 4 legs to this. So I'm paying so much commission here, correct? So there are specific times you do these kind of trades. But somebody paying you $51 and you can make $2,000, I would always try to take that. Why would I not? Correct? And these complex strategies, anyway, if it was easy, everybody would be making money. That's how I look at it, right? If you are anyway learning about options, if you are trading options, learning a little bit of the Greeks, learning how to combine certain things, you are reducing risk. Yes, somebody is having $100,000 account and buying a $900 Tesla option may not seem big, but how many times are you going to go wrong? I just see it, the way I look at trading is, if I put in less money and the entire world goes against me, I'm losing less, right? Your analysis may be correct, your technical analysis may be excellent, everything works in your favor, you have done all the prudence, and still some news comes out, you've lost the entire capital that you put in. So why put in $900 for an out of the money option on something that moves huge? One day it's up 50 points, the next day it's down 100 points. You want to go ahead and speculate on Tesla's direction? Go ahead, put $1 on it. That's like just going and eating out one time. I'm fine with putting that much money for a speculation. So I don't do these trades every day. They are not meant to be done every day. But yes, broken wing butterflies provide a huge amount of income kind of trades for me, because if I know somewhere it doesn't go, right? The expected move on think or swim, you can see, you know where the option is usually pricing it for where it can go. Why not sell something there? Right? Tesla is stuck unless and until it does not blow about 930 or 940 or whatever, it is not going to 1,000. But the IV is so huge that you can sell something there. Why would you not take that free money? Knowing your Greeks and knowing when to sell and when to buy. I am not saying that I don't buy directional calls. I do that. Yesterday, I took Facebook calls for a day trade, made money. Today, I'm doing a butterfly because today is choppy. It's not as directional as yesterday. That's all. Any other questions? So I'm done, David. No more questions.